With chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 3rd, 2024. Unfortunately, it's not May 4th. If it was May 4th, I could do the Star Wars joke. I could say, may the 4th be with you. I could use my Yoda voice. I do a great Yoda impersonation, but unfortunately, it's May 3rd, so you will not get to hear it today. I apologize. Let's talk about what's going on with the markets this week. Before I get into the numbers, let me talk to you a little bit about the market itself. Now, last month, the S&P finished down pretty substantially, down over 4% for the month of April. Took a really big hit. I'm happy to say we did not. We actually performed very, very well, down under 2% for the month, so like 1.8, something like that. So we did very well by comparison. But the market took a big hit, and it's looking a little dicey there for a bit, and it seems like it's starting to firm up some. What's happening right now is nonsensical. Let me tell you this. The market's reacting to tons of noise, and it doesn't make sense. I don't know why markets do that. I think a lot of things have to do with computers these days. You have a lot of algorithms that are tuned in to keying off of certain words spoken by certain people or certain reports, economic reports, etc., and they kick into gear, and then the market, I think, sometimes follows along. Because I think it's worse than it used to be earlier in my career. But nonetheless, the market's been reacting to a lot of noise. And this week, we saw that tug-of-war happen live. I mean, we just watched it unfold. Earlier in the week, we had a report called the Employee Cost Index. Okay, something that I've not really heard anybody pay much attention to in 25 years, but they paid attention to it this week because it came in a bit hotter than expected. And this is the index that tracks the total cost of an employee to a company, wages, benefits, etc. And if it's running hot, that can be a bad thing because it can mean more inflation in the future, things along these lines. So it was a little bit of a hot number, and the Fed does pay a bit of attention to that. So the market reacted very negatively, took a big hit earlier in the week. Then we had the Fed meeting, and the Fed meeting was what we would call dovish. Jay Powell, the Fed chairman, really doing his best to put out a voice of calm for the markets, of accommodation for the markets, trying to let the markets know that he's still planning on cutting rates, etc. And the market really reacted incredibly strong during the press conference, and then it just kind of tailed off at the end of the day and finished flat on the day. Then this day here, Friday, we had a lot of economic data. We had some PMI numbers, service PMIs were weaker than expected. We had the payroll, the April jobs numbers today, and the jobs numbers today were a Goldilocks number. They were just right for this market. They were not too hot and they were not too weak. They were weaker than expected, and the market wanted to see that. It wanted to see a lower jobs number. It wanted to see unemployment tick up, and it did. It went up a little bit, went up 0.1%, up to 3.9%. It wanted to see wage growth subdued, and it came in less than expected. These are the things the market wanted to see, right? Fewer jobs, higher unemployment, and lower wages. Isn't that terrible when you really think about it? Isn't that freaking lousy that the market would want to see that type of negativity on the population? But that's what the market's looking for. Why? Because the market wants to see the Fed cut rates. That's what the market wants to see. I don't understand why the market wants to see the Fed cut rates, because when you study history, you'll find that the pause between the end of rate hikes and the beginning of rate cuts tends to be a really strong time for the market. That's what we're in right now. And from the first rate cut on, markets historically perform very, very poorly because the Fed's usually cutting rates to bolster the economy because things are slowing down too much because it's slipping into recession, et cetera. I think the market is having this fantasy that the Fed can cut rates preemptively and avoid a recession. I'm not so sure that's going to happen. When you look at some of the data right now, the consumer data, things like that, you listen to some of the things that the companies are saying, you're seeing that consumers are trading down a little bit from name brands to generics, things like this. I think that potential for recession in 2025 still remains. 2025 into 2026, I still think it's a possibility no matter what the Fed does. And I think what the Fed does not want to do is to allow inflation to ramp back up again. I think that would be a mistake. And I think they've got to be mindful of that. So I'm not so sure we'll see any rate cuts at all this year, but the market after this week is very hopeful that we will. So taking a look at the numbers, it was a solid week. The Dow Jones up 1.1%, the S&P up 0.5%, the NASDAQ composite up 1.4%, and the Russell Small Cap Index up 1.6% on the week. Volatility came down big time this week, down 10%. The volatility index, the VIX, down to 13.5%. Very low, very complacent number for the VIX. I think a lot of that was the Fed meeting. I think the volatility was a little high ahead of the Fed meeting. And once the Fed press conference didn't upset the apple cart, the volatility came down pretty substantially. Look at some other things. Long-term bonds, the TLT up 1.8% this week. So that was good to see that get a little bit of love. And we take a look at the sectors. Everything was just kind of like so-so, not up a whole lot, mostly less than 1%, 0.5% or so. Except for utilities, which were up a lot. They were up 3.3% this week, and technology up 1.5% this week. So interesting to see technology and utilities in tandem because normally one does well, the other does poorly. Utilities tend to be very defensive while technology tends to be more growth oriented. And then taking a look at gold and silver, they were both down for the week. Gold down 1.6, silver down 2.6 on the week. So that's what's going on. As far as our moves this week, I did make one tweak. We had a stock in some of the models, Ring Central. It's a voice over internet company and it just hasn't been getting the traction I like to see. I sold that this week and moved those proceeds into a company called Snowflake. And Snowflake is a data management company. Data is like the most important thing in the world these days to big corporations. It really is the most precious asset they have. And they've got so much of it, they don't really know how to manage it or extrapolate the information that they can get the most use of out of it, et cetera. Snowflake helps them do all of that. One of the best companies in the business as far as their technology and executing those types of things. So pick that up this week. We had picked up two investments last week in healthcare. Pfizer, which was up 10% this week. We bought it last week. It was up 10% this week. Happy to see that. And the biotech index, the XBI, which is the S&P Spider Biotech Index, that was also up 10% this week. So, or at least 10% up from where we bought it last week. So that's pretty timely there. I wish I could do that all the time. My goodness, I would be the richest person on the planet. I would not be doing a podcast on a Friday night. All right. Well, hey, that's what I've got for you. Things look good. The market's hanging in. I do think that we can still see some choppiness. Seasonality is such that the market is not necessarily going to go straight up. I still think intermediate term technicals look a little weak. Shorter term technicals did strengthen a bit this week. So we might see the market continue to kind of hang in there for a week or so. But I would not be surprised to see another downdraft here in the summer months, May through July or August. And if we get that, we do have some more cash on hand to do some more buying. We've done some buying this last dip. If we get another pull lower, we'll jump in and do some more. So I do think the market goes higher for a bit. So with all that said, between now and next week meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early or just retire, buy a second house or buy your first house or take a big trip or buy a boat. It's fishing season. Hey, you know what your goals are. Don't just think about them. Think big, think big, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.